Is it going to be another record-smashing day for our markets? It's the Nifty expiry, and the first tick on the Nifty pushes us closer to 19,400. The Nifty straight away off the bat opened with a gain of about 50 points plus. The Sensex higher by 200 points. The Nifty is now settling with a gain around that 19,380 mark. Mid-caps too have opened higher in step with the large caps. The mid-cap index currently up close to about 0.25%. The big gainers. Top of the list is Bajaj Finance, 4.6% higher. The street likes the Q1 provisional update, the 30% plus growth in the AUM, and the stock is flying in trade. Bajaj Finance is giving it company. That's the second biggest mover, 2.9% higher. In the auto pack, Hero Motorcorp has got a thumbs up from the market about its X440 bike with Harley Davidson and the pricing. Stock is up close to about 4.5%. Bajaj Auto sold off yesterday, so it's rebounding today. But on the flip side, Eicher Motors is taking it on the chin. The street is worried about market share erosion from Bajaj Auto and Eicher's entry into the premium motorcycle segment. With the partnerships that they've done, Eicher Motors is currently down close to about 3.6%. Bharti Airtel is also losing in trade. The street is worried about Jio's aggression in the device market and what it signals about tariff increases and possibly the potential loss of their 2G subscriber base too. So Bharti Airtel is under pressure. The Nifty is still holding on to all its gains. In fact, now crossed that 19,400 mark. So there is no stopping this juggernaut, at least as of now. So after piling on 600 points in the last 4 days, today it looks like it's going to add a century.
It has almost a century on its back, Rima. 19,400 is here. It's interesting, a bunch of stocks from the broader markets doing well as well, but the large cap names, as you pointed out, have been doing extremely well. Stock of the moment right now clearly is Bajaj Finance, almost 6.5% higher, taking your breath away. The pair trade is in IDFC and IDFC First Bank. There is long IDFC and short IDFC First Bank. So that's playing out. But a bunch of other stocks doing extremely well too. Kansai Nerolac goes ex-bonus today. Was a big gainer yesterday as well. Is up around 6% odd. Genus Power is up in double digits. That's on account of a 2,200 crore order win that we've seen. Avenue Supermarts opened mildly in the green and that has sold off. It's seen a cut of about 0.5% odd. And finally, we have decent numbers, a 12% organic revenue growth, 16% overall revenue growth in the first quarter coming in for V-Mart Retail as well. So that stock sitting with gains of almost 2% odd. Saxoft is the other one which is doing well. Momentumizer stock, Taneja Aerospace continues its momentum, up around 4.5% on that counter too. So broader markets doing a lot better in terms of the market breadth, even as at the index level, we see a wee bit of underperformance, and that's largely because a lot of the index heavyweights are doing a lot better.
Well, gains attract more gains, Mangalam, right? I mean, So this is super, super strong, right to the word go. 85 points, 19,405, 19,406 is what we have. So, we were talking about 600 points in 4 days, make that 700. With, of course, if the gains hold by at the end of the day. But that's how fast-paced the move has been once we took out the all-time high of 18,887. And by the way, the price activity for the last couple of days has completely turned. I mean, you would expect a dip and then by the dip kind of a price action. But now, intraday you may get a small dip or something like yesterday, for example, but nothing large, right? Intraday or at open, which gives you the opportunity to get in. Instead of trying to buy the dip, you've got to be willing to actually, buy a little higher to be even higher. So it's changed. The texture seems to have changed a little bit. Now, just a few other names. Suzlon is now at 18 rupees. It was up 10% yesterday. Suzlon is coming up with very strong volumes once again. And it's up another 8% this morning. It's the third largest volume traded stock with very large price moves as well. Bajaj Finance we highlighted. Finserv is up 5% as well. 14 on Bajaj Finserv. Finance is, of course, up 8%. Genus we highlighted. JSW Energy is up 3%. JSW Energy was up about 6% yesterday. A fair bit of interest coming through in power and especially JSW Energy over the last couple of days. Angel One is coming up with about a 2.33% gain, 1788 on Angel One. There is Credit Access, which is up 4%. Stocks at about 1,312. Super name and super strong gains this morning. We've got Zensar Tech, which is up 2.5%. Traxon, which is in a way considered as a sort of a proxy for market data, 7% higher on Traxon, 93 on Traxon. Inox Wind is up about 2.25%. You go down the list, volumes start to come off a little bit, but there are a lot of names which are jumping about. 63 Moons, up 5, down 5, up 5 today. I mean, so 237 on 63 Moons at this point in time. On the downside, iShares and IDFC first, right? Both of them are down 4% respectively. And there is Bharti, which is down about 2% as well, almost 2%. And L&T Finance, which saw a very sharp move yesterday, is seeing some profit booking. It's down 3%, 132. Stock by close was up about, I think, 6 or 7% in yesterday's session. Well, Sanjay Mukim is our market master of the day. He's strategist head of India Equity Research at JP Morgan. Sanjay, it's a pleasure. Great to have you with us here. Thank you very much for your time. Your latest note is interesting. It's unconventional. You're talking about your travels to rural and semi-urban India and the findings that you have. Maybe a little bit of an unfair question to ask you to directly tell us the findings of what you saw in your travels to what the market is doing, especially on the rural side, Sanjay. Because that's been a bit of a worry, right? That at the lower end, especially on the rural side, things have been weaker, etc. Are you seeing signs that is changing? Go on.
So there are two different answers to your question. Good morning and great to be on. One, of course, is your view or the query on what rural India is doing in the near term, right? Whether you're seeing a revival of demand. Now, we'd argued in our note earlier in March that the conditions for a resurrection of mass market consumer confidence are in place. Jobs have come back post-COVID, wage inflation is higher than it used to be, and consumer confidence is looking better. The debate to have, is whether you will see that revival in demand in a 3-month period or a 6 or a 9-month period. But the note we did today actually looks at India's growth dynamics from a longer horizon. This is not a 3, 6, 9-month research piece, but to look at the fundamental changes or fundamental improvements in the broader consumer pyramid in India. And there are two sort of narratives there. One, income levels are still relatively low and it needs to continue to go up. So there's a potentially lot of upside. But when you do go and visit people and talk to people on the ground, you do realize that over a course of time, there has been significant improvement in the social safety net, in the facilities that are available to the bottom of pyramid people in India. And that underpins productivity growth, that underpins the long-term consumer outlook for India and increases assurance in long-term growth in the economy. Right? And therefore, the bias there is to say that, look, if you can find companies that are exposed to it, you should have a long-term positive bias to a B2C domestic-facing consumer set in India. You just need to find the right execution set of companies in India. So on a long term, you always continue to have long bias to Indian stocks, especially those focused on the domestic economy. In the near term, you will have to wait for this revival, which also we think is actually underway.
Sanjay, morning. Just taking a look at Bajaj Finance's numbers, it's quite extraordinary that a company, that an NBFC of this size is growing at 9% AUM quarter on quarter and more than 30% on a year-on-year basis. And of course, the stock is getting rewarded today. Is this something that could be replicated by the other big banks and NBFCs in India? Maybe are we underestimating the kind of growth, the credit growth, the AUM size increase, the disbursements growth that India could see, these large banks may clock in the next 2 years?
Without referring to a single company or a stock here, our view is that system loan growth in India will actually decelerate in the coming few quarters for two big reasons. One, nominal GDP growth last year was very strong and you had inflation and WPI was high, which drove credit demand partially. And that phenomena is going to go away in the coming quarters. WPI is already negative as it is. And nominal GDP comes in at the 10-11% mark, which is the current base case today. But the second constraint that the financial system in aggregate is likely to face is a lack of deposits. Right? There is only about 10% deposit growth in the system. People have had surplus liquidity carried over for a variety of reasons, which they have redeployed into lending. But that phenomena can persist for only so much longer. So for the entire system, the credit growth momentum is likely to moderate into the low double digits to my mind. What you need to pick out is which particular financial company has the capacity and the willingness to grow faster than system. Now, historically, you've seen that the private sector banks have always gained market share and done 6 to 7% higher than system loan growth. The challenge now is that the private sector is more than 40% of total system. It's no longer a smaller component. And the PSU banks are also competitive for a variety of reasons. So it will be an interesting next few quarters to figure out how these market share changes happen and whether a large number of financials can continue to outgrow the system, which theoretically is challenging.
Right. Sanjay, just before we speak to you about your sectoral preferences, keeping an eye out on a couple of these stocks where there would be pre-positioning ahead of their pre-quarter update. So Titan is up around 1.5%. Godrej Consumer is the other one which is doing well. And we're seeing some performance rise on names like Trent, retail and consumer discretionary, Jubilant Food, which was one of Sudarshan's calls, doing extremely well as well at the high point of trade. Sanjay, you were a naysayer on IT for the longest time, and that's worked out extremely well for you. The Nasdaq is up 32%. Everyone's talking about artificial intelligence and that reducing the cost for a lot of these IT players and impacting their margins. Do you think the time to buy IT has just been delayed further?
Yes, so we are in the camp that it's a bit too early to look at Indian IT companies on the basis of their correction or on the basis of a valuation anchor or any of that sort, because we expect many of these companies to come in with numbers weaker than expectation in this or the next quarter. And some of the mid caps or smaller names are also trading at very elevated valuations as well. So you're likely to see earnings misses, downgrades, and valuations again are not at supportive levels to our mind. There may be these technicals, people keep talking to me as well, oh, Nasdaq's going up and tech's rallying and all, but I those things don't matter. If companies miss earnings, then the stocks will remain under pressure to our mind. Now, at some point, you may be able to make a call that, the demand momentum globally is bottoming and there are possible signs of a revival in IT demand. I think that it is too early to make that call just yet.
Got that. Although, you have a very broad perspective, Sanjay, because of your global coverage as well. The expected weakening in global demand, especially US demand, is just not happening, right? And people have been waiting for it for at least a year. Rates have gone up 500 basis points and data is just coming in strong. Maybe once in a while you get something which indicates some softening, but nothing large. By and large, still strong. So in that light, Sanjay, I mean, how does that, do we need to reassess it's, as we get into the second half of this year about what we thought this year would be like at the beginning, especially with the export-oriented sectors like IT?
So yes and no. So we are seeing feedback from companies that consume IT services that their approach to spending growth has turned very conservative, right? Now there are two sort of narratives. One is what is happening to the economy and whether the consumer is slowing down. There are signs that there is some slowdown, maybe not as rapidly as you would have expected, but the direction is softening a little bit on growth, on consumption and so on. But the feedback from people, the large companies, the BFSI, retail, is still very cautious. So we still expect that the IT universe growth of demand will come in weaker than people's current forecasts, right? So that remains a concern for us. The bigger question to your point is, look, if the economies don't slow fast enough, then the Fed will not have the reason or opportunity to cut rates and reverse its QT, in which case there is a significant gap in equity valuations. If the current liquidity tightness continues and liquidity withdrawal continues and rates remain high, equities are mispriced, and then this rally may turn out to have been very premature.
All right, got that. Thank you very much, Sanjay. Appreciate you joining in, and it's a pleasure having you with us here as always. Thanks indeed. The big story, of course, is the IDFC Bank merger, long-awaited one. The merger ratio, etc., being announced. Stocks reacting. IDFC first, by the way, of course, was lower, and IDFC has given up gains. It made a high of about 115, and I think it's now absolutely flat. I'm talking about IDFC Limited as well, which has given up gains. IDFC, we have the management joining us to take forward that conversation. Mr. Vaidyanathan is Managing Director and Chief Executive Officer at IDFC First Bank. Mr. Vaidyanathan, good morning. Great to have you with us here on the program here at CNBC-TV18. And congratulations. Long awaited, finally done. Could you tell us what are the next steps? I mean, as we as we look forward for the consummation of this merger, what are the next steps?
First of all, yes, we are all very happy that we are over and done with this, and there is a very clean corporate structure, and now we can look forward to building the bank moving forward. With regard to your question about what is the next step, frankly, we got to go through the process. We got to take approval from the regulator. We got to go through NCLT, go to shareholder for approval. But we believe all that will follow will get done hopefully in 9 to 12 months.
Okay. Well, Mr. Vaidyanathan, good morning. And again, as you said, congratulations on simplifying a structure. But long overdue, isn't it? What went into all this thinking? Why the delay and what were the considerations?
Well, the main consideration is to how to find a fair value for all shareholders. And, there was a certain holding company discount in IDFC Limited. IDFC Limited holds about 266 crore shares of the bank, and they have issued 160 crore shares. So the intrinsic value is about 1.66 shares of IDFC Bank for every shareholder of IDFC Limited. On the other hand, there was a market price. On the other hand, there's a value for IDFC Bank. There's a comparable value. We'll go through all these processes. So you got to find a statutorily, a process that is accepted statutorily and in compliance. So all the process took some time.
Okay. Well, there was one shareholder complaining to me on a message that the 6.1% holding company discount would mean that the government gets 6.1% less. They would have got, 2.62 crore shares now of IDFC Bank, whereas they should have got perhaps more than that, 6% more than that. No complaint from the government on this, was there?
No. So first of all, to correct your numbers, they are getting 1.55 shares per share of IDFC Limited. Against the intrinsic holding 1.66. So but to your question about government, well, we respect the holding of government, and there is also other shareholders. There are also minority shareholders. That's why the process is working in such a way that's fair for everybody and all shareholders. And to the point of that's how let me leave it at that. And by the way, government has also holding an IDFC Bank. To the extent of about 4%, about 16% there. Government is broadly neutral, just to put it like that, broadly neutral. Because
I'll just say, I think I'm splitting hairs over here. They would have got 43 crore shares without the 6% discount. Now they get 40 crore shares. Anyway, I was just wanting to know if the government said anything. Okay, now,
and they're on both sides.
Okay. Anything you heard about the MSCI inclusion? I think Nuvama has put out a note. That will mean much easier ability to raise capital. But any clarity on that?
Well, we consider it our privilege. I think it's a huge moment of our lives. If an event like that happens, we are told we are a few percentage points away from getting to that landmark. And because once you enter the MSCI index, there is a certain amount of flow of dollars that comes in the stock. In the last research report from Nuvama I read was that about $170 to $180 million of purchases will happen in our bank once that happens. Now, I'm not an expert at all these things, but I'm just saying that it will be fantastic for the bank to get that kind of stature to be as part of MSCI index, an arrival of the bank, let me say.
Okay. Now, how does life become easier, or how does it change for the management? You don't have a big shareholder now. Does that mean more elbow room?
Well, in any case, if one entity has 40%, if you've got to have a resolution for, say, raising capital, you need specific support of that block of shareholder. And by the way, we had a good relationship with that entity. But nevertheless, you still need those approvals. You need resolutions to be cleared, and you need one entity holding that kind of voting block. With this process, what will happen is that becomes, the shares get distributed IDFC Limited. It's a very diversified public shareholding, institutional shareholding. Think of it like that. So you're able to raise capital from time to time, just from the market, like how ICICI or HDFC, they all raise from time to time, and they keep going. It's good, in that sense.
Congratulations, sir. Rima here. Just want to get a sense about the capital position. Will you be getting any capital from IDFC? What will be the cash on the bank's book now post-merger? How does your capital adequacy change? And post the merger, you even spoke about it's becoming easier for you to raise money. Would you be looking to tap the markets and raise some money? Just give us the overview on the capital and the cash.
Yes, that's an important point, by the way, because apart of, we're paying this ratio of 1.55, but you should also remember that IDFC Limited has approximately, give or take, about 600 crores of cash, which we're expecting to come as part of the merger into the bank, into the merged entity. Now, to that extent, the capital of the bank goes up as part of the merger, and that is already factored in that price. So, in that sense, it's to specific, by the way, on your question on capital adequacy, our capital adequacy is now. We just raised some Tier 2 capital last week, by the way, of 1,500 crores. Our capital adequacy has become about 17.4%. With this, we'll get some more capital. And of course, raising capital becomes easy. We do expect, by the way, by the end of this year to raise some more capital, about 2,000 crores. Okay.
How much would that capital be?
2,000.
Give or take about 2,000 crores.
All right. Just wanted to understand post this merger. I presume it would take about 9 to 12 months, given the sort of approvals that are required.
Right.
Right. So post this, what does the combined, growth or the growth for the combined entity look like in terms of business and then asset quality? How does that go from here?
Nothing called combined entities. There's a bank only because there's no operating business in the limited. But to your question right now, as you know, if you've seen the numbers the last few years, we've been growing about 25% per year on the loan book for a while. We guide for 22-24, but this turns out to be 25. So that story will play out. We feel that for quite a while. We feel very confident, and we'll discuss reasons if we have time. On the deposit side is what we are really hitting the ball out of the park. Our bank is enjoying a really good range. We are getting deposits over 45% year-on-year growth until last quarter's numbers. This number is not out. So business is looking very good, actually.
No, your deposits have grown, I must say almost savagely, 55%, I think, when you last reported. But is it becoming a little expensive, Mr. Vaidyanathan? After all, the big HDFC bank is borrowing, and that's pushing up costs for the entire sector. So how much have the cost of deposits gone up for you, if at all? And how are you likely to do, therefore, in terms of NIMs? Is the best behind you?
No. First of all, the best is not behind us. I think we'll be.
I mean for the year, not in terms of a decade.
No. Even for the year, we feel that comfortable that we sustain for the rest of the year our 6.41%. But to your more specific question about how the cost of deposits have moved, I'm actually very happy. I don't know how, but I know the bank has got that sort of a stature. We brought down the rates of deposits from 7% to 4%, like that. 300 basis points drop. I don't think anybody's done that kind of a cut in a long time. For up to 10 lakhs, we are still there at 10%, but our deposit is still surging at 44%. So just think about it. You drop rate by 300 basis point, deposit up 44%. So it's working. That's all I can say.
Yes.
Mr. Vaidyanathan, in the earlier answer, you did mention sort of the diversified shareholding, right? No promoter like ICICI, HDFC, etc. And you've made that point earlier. I mean, in terms of sort of businesses that you would like to grow on the lines of, I mean, those are two institutions you admire. I mean, just give us a slightly, say, a 2-3 year kind of a vision. How would you like to grow, and what would you like to get to in terms of size of assets, size of business?
See, if you grow a loan book by 25% for 3 years, what the book like, how the maths work. It looks pretty good. And deposits we expect to keep, growing, but I'm in a silent period. Please don't push me on that line. I have to be very careful here. But with regard to the previous comment you made about ICS, HDFC, these are hallowed institutions which our country is proud of, and of course the other good names as well. So once there is no promoter shareholding, there's no promoter. If you think of global corporations like Bank of America, JP Morgan Chase, no promoter. They just keep go on for centuries. So we should think of this like that. And,
Okay. No, I agree. That certainly gives you all much more elbow room as a management. Just a final question, because I'm being warned we're out of time. Your risk-weighted assets are also high. And if you grow at 25%, the Reserve Bank itself has shot out a letter to everyone about unsecured loans. Would you worry that your lending is a tad riskier?
Not at all. Not at all. You should see what do you call risk. Basically, you see end of the day, your gross NPA of retail is 1.6%, net NPA is 0.6%, SMA is 1%, and just mind it, 1% SMA, free NPA stage. Really big. And it's been like that for 10 years now. So things are very fantastic. We are very careful, we're very watchful. We watch it like a hawk, that we should never have to report NPA more than 2%.
Okay. No, it is just, I mean, as the governor said when he spoke to the directors of all the banks, mistakes are made in good times. So, I mean, I agree that the entire banking sector is moving.
No, absolutely. He's right. And we greatly respect that point of view. We really do. And in fact, after his comment, we came back and once again looked into our books, once again made a presentation to the board, and we poured over everything. So we respect that and we'll be very watchful. We are very careful.
Okay. So you expect 25% growth for how many years now? For that foreseeable 3-4 years? I'm asking you long term. I'm not asking you for an immediate guidance.
Okay, yeah. So we should talk long only because I can't comment in short. But we guide only 22, 24. And, if you get there in the zone, you should be happy. But yeah, I mean, this is, you see even big banks like ICICI and HDFC is growing at 20% for a start, for early stage bank. These are not really big numbers. They're very moderate.
Yeah. I agree. The base is helpful. Thank you very much, Mr. Vaidyanathan. We'll invite you for a more detailed conversation. There are other guests lined up for today. Many congratulations, of course, for this long-awaited reverse merger.
Well, interesting conversation, Mr. Vaidyanathan. Thank you very much. He was talking about those hallowed institutions, ICICI, HDFC. He was part of
ICICI. ICICI has provided leaders across
the board. So
absolutely. And even now, Sudipto Ray has joined L&T Finance. So clearly they are providing. But I mean, you have to congratulate Vaidyanathan himself. I mean, when he started Capital First as an NBFC, and then to go on first get into IDFC and then do the reverse merger, I think it's personally a very satisfactory and impressive.
And always extremely excited about the business, right? I mean, what the potential, etc. is. So great to finally see that merger going through. Not going through, it'll take time, but of course, the first steps being taken. We'll take a quick commercial break here. Up next, we'll be joined by Ameera Shah, promoter and managing director at Metropolis Healthcare, to discuss their growth outlook. Later in our special segment, Charting Trends, Rahul Sharma of JM Financial Services will talk us through some specific charts, Nifty, Bank Nifty, the NSE 500, and a few others. Stay with us.
Welcome back. The mid-cap index has now dipped into the red. Even the Nifty, which has scaled the summit of 19,400, has eased from the top. So some profit booking is setting in. The Nifty is now down to levels of 19,350 in the green, but the gains are quite slim, and the mid-cap index is currently in the red. The advanced decline ratio, for now at least, is holding up in favor of the gaining side. But we've got the management of Metropolis waiting to chat with us. The stock in the last 1 year hasn't given any return. It's only up close to about 3%. The street is concerned about the increased competition in the diagnostic space. But has that competitive intensity eased a bit? What's the current landscape right now? Because we haven't seen too many new entrants in the diagnostic space. We are now joined by the promoter and the managing director of Metropolis Healthcare on the show now to talk about the way forward. We've got Ms. Amira Shah with us. Thank you very much for joining in. Can you talk about how competition is? Has the discounting eased, at least from the new tech players? Just tell us competition right now and the way forward, according to you.
Hi, good morning. So I think, there's been a lot of confusion around the diagnostics industry in this past year. And I think people have assumed that, revenues or profits have been impacted because of competitive intensity. But actually, in reality, the reason we've seen 22-23 obviously be a little lower than the year before that has been more because COVID has come off. And because of that, it impacted the revenues and the profits of all organizations in the industry. Actually, if you look at the non-COVID, if you look at our core business in FY 22-23, it grew at about 15%, of which 13% was volume growth and 2% was a revenue per patient growth. So actually, which is very similar to what it was pre-COVID. So competition has come in, of course, in a bigger way. But frankly, in our industry, we've seen competition for the last 10 years. It's not something very unusual. We have seen online players. We've seen some corporate entrants as well. Having said that, in the industry, we have to realize that diagnostics is not one big industry. It's actually nuanced sub-segments of the industry. So it really depends on where you play. Metropolis really has spent most of our time in the illness sector, and that too in the more critical illnesses. And therefore, when doctors and patients are coming to Metropolis, they're coming because they truly need good quality results where they're very sure of accuracy. The moat around the business is more around the trust and the credibility which the brand enjoys, which frankly takes time to build, is difficult for any new entrant to build overnight because it requires very fundamental expertise. So we have seen competition come in. Metropolis has not seen any large impact because of that. We are continuing to grow well in our core business, and we expect to do the same next year.
Have you undertaken any price hikes in any of your tests?
We have actually in the last 2-3 months, we've taken some price hikes in about some variety of the tests. So actually our normal way of doing price hikes is never at one time, all tests at all locations, but we usually do different locations, different test categories at different times of the year. So we just did one as of April 1st, more in the specialized segment, a few hundred tests and marginal increases about 4-5%. So I think overall, we're continuing to see that price increases are possible. We are continuing to see that even though competitive intensity did come in and discounts did go up, we are starting to see those discounts ease because we are also seeing that competition is understanding that discounting doesn't get you very far in healthcare. Right. You really have to build expertise.
Patients are one end of the spectrum. The other important stakeholder are your vendors and your franchise partners, etc. All competitors have perhaps also understood that for them to grow, they have to expand their network. In that situation, how's the bargaining power of franchisees and partners been? I mean, has there been any change in revenue share? Are they pushing for a higher share of their revenue, given they have other options now as well, poaching in this space?
So actually, we have to understand the role of a franchise, at least for Metropolis, is more of a service provider where they actually collect the sample when our patient walks into that center. If it is a B2C franchise center, and also we also have B2B franchise centers where they only pick up samples from hospitals and labs. But when a patient walks in, the demand generation is done by Metropolis. The service fulfillment is done by the franchise. So even when competition comes in and there's always an attempt to poach your franchise partners from you, we usually find that the best quality, the most productive franchise partners never leave because they understand that the business is being generated by the brand and not by them. And therefore, that bargaining power that you're referring to doesn't actually become much stronger in the hands of the franchise, even when competition does come.
Amira, hi, good morning. Prashant here. Two questions. One, so we should expect 15% growth in FY24 as well. You said similar growth should be maintained. That is point one. And second, when we speak with companies like Dr. Lal, etc., they say that bundled tests, right, many tests together, they become very popular. And that kind of also is a price advantage for consumers, and that's why they opt for it. So are you seeing a similar trend?
We certainly are seeing bundle tests go up. I think it's more not only because of a change of consumer mindset, but also because organizations like us are giving opportunities to consumers to say that, look, would you like to create a bundle package and do more tests since you're giving your blood anyway. Having said that, this is not hitting the profitability of organizations. Actually, it is contributing to the bottom line as well. So I don't see this as a negative way of either reducing the RPP or by reducing the EBITDA margin in any way. On your question as far as the outlook goes, last year, as I mentioned, on the core business, which is keeping aside COVID, keeping aside acquisitions, keeping aside government contracts, any of those, we saw 15% growth. Going forward, again, I think a 12 to 15% growth on the core business is very doable. As a mixture of volume and price increase. But that obviously does not COVID and acquisitions and government contracts.
Sorry, overall business revenue growth would be, Ameera, 12 to 15%?
No, I said that would be for the core business.
The core. So what would be the,
COVID will still impact a little bit because this year in 22-23, we still saw some COVID revenues, which are obviously not continuing into 23-24. So there are some adjustments because of other ecosystem areas, but otherwise in the core business, we do believe 12 to 15 is possible.
And just one more number, what percentage of total sales are through these bundled sort of tests now?
For us, it's about 15%.
And that is growing rapidly?
That is growing well. And like I said, it continues to be profitable for us at the bottom line.
But it would, just as a layperson, bundling many tests together as against paying for each individually, I'm assuming that there would be some trade-off, right, in terms of pricing as a business.
Of course there is. There is certainly a benefit for the consumer when they do bundle tests. But what we have to remember, if you look at the P&L of diagnostic companies, the servicing cost of a customer is as significant as the material cost in doing a test. So actually, when you're adding multiple more tests, you are incurring obviously a higher material cost, but that additional incremental revenue that it's giving you does help you on the bottom line as well. So overall, we find this to be very profitable for all the industry organizations, assuming that you're getting them still at fair prices, right? This is not for any bundle package. There are companies who are offering 100 tests at some 700,000-800,000 rupees. Obviously, that's not the same result for them. We are selling more premium wellness, premium bundle package, which means a higher quality, higher service. Patients and consumers are willing to pay a slightly higher price because they know they're getting a far better quality report. So overall, it still makes sense for us.
Okay. Very quickly, just one last question. You had plans to open 30 additional labs this year and 600 to 800 collection centers. Are you on track? And considering that there is going to be a more focus on opening your centers in Tier 2, will it be margin dilutives? Could margins in FY24 be under pressure on account of this?
So actually, if you look at it in FY22-23, we opened approximately 15 labs. We are in a process of an accelerated lab expansion from FY21 till FY25. Despite opening 30 labs 15 labs in FY22-23, our margin dilution was only 1.5% compared to pre-COVID, where we were at 27% EBITDA. We reported a 25.5% EBITDA in 22-23, and that was primarily because of this accelerated lab expansion. We will continue that in FY23-24 and 24-25 by opening 30 labs in each year. But we are aiming to keep our margins consistent at 25.5% for the next couple of years. And at the end of the lab expansion, which is after FY25, once with this margin dilution is not happening anymore because of the accelerated lab expansion, we can then hope to see margins expanding.
Just wanted to know your target share coming in from premium wellness, because that had increased to somewhere around mid-teens. What do you think it stabilizes at? What's your aspiration there? And in terms of new network as well, that contributed around 3 to 5% of your revenues. What's the target there?
So currently, premium wellness is about 15% of our overall revenues, and we're hoping to take it closer to 20. You're right, the new expansion contributed about 3% of the overall revenue. And we expect that that will move up closer to 4 to 5% in the next couple of years as we accelerate the lab expansion as well as the collection center expansion. We are very much on track to open 30 new labs in FY 23-24 as well as the collection center network. In fact, I think we're going to do much higher than the collection center network, much higher than what we had projected, which was originally about 600 centers a year. We're actually aiming to do closer to 800 centers every year. So I think we're certainly on track. We will continue to maintain margins despite the accelerated expansion. And we believe that this will bring good growth to the organization in the years to come.
By the way, Mangalam, there was a report that Google is their AI. I don't know what it's called. They basically a retinal scan. They're working with the Sankara Nethralaya, which is one of the top hospitals in Chennai, eye hospitals, and they're doing so a retinal scan will tell you the probability of a cardiovascular event a year in the next 1 year. I mean,
irrespective, you have to go to the doctor. I figured this because a lot of times.
No, I'm saying from a diagnosis perspective. I mean, you don't have to. It's a. Anyway, I mean, it's a completely new way of doing things. But you're right, Mangalam. I mean, it doesn't replace the doctor. I don't know. Amina, you want to say something?
wants to come in on this.
Yeah, I was just saying, look, I think it's really exciting with all the innovation and technology. Lots of changes in healthcare. But we have to remember, any consumer, even if you do a scan and you feel, okay, I may have an... It's great for the awareness, but you will finally go back to a lab or to a radiologist to confirm it before you take any actions.
Great speaking with you, Amira. Appreciate you joining in, and good luck and good chat as always here on CNBC-TV18. Well, Rahul Sharma is joining us, Director and Head of Technical and Derivatives at JM Financial Services. Rahul, good to have you with us here. Sorry to have kept you waiting. By the way, look at the market. The Nifty is basically climbed down to being absolutely flat. We were up 80 points, and you got 8 points left now, 19,332. Just a one-way kind of a move lower, gentle slope lower. Rahul, you've sent across a couple of charts and we'll put them up. I want to start with the NSE 500 first. Not the Nifty or the Bank Nifty, the NSE 500, which you're calling is the breakout of the year. Just talk to us about what you're seeing.
Yeah, so if we go slightly back around when in March, April, the markets were turning around, it was the Nifty 500 index which did give the breakout first, and then it was followed by Bank Nifty and the Nifty index. Now, this time around, what is happening is structurally, there is a very good, strong ascending triangle pattern that has been formed on the monthly charts. Last week, we saw a phenomenal monthly close, a very strong weekly close as well. And mind you, this is the Nifty 500 index, which is more of a broad market indicator, which translates into at least 10 to 15% upside in the coming 3 to 4 months' time, which could mean a lot more upside for the individual stocks as well. So I think this bull run in terms of Nifty has just begun. We're just 3% away from the previous all-time high, around 19,500 odd, 19,350. There is a bit of resistance for the short term as well, but I think dips, if any, are to be bought into. And considering the market breadth, considering the way FIs have gone aggressively long on the index futures, considering the way client positions or retail positions are stuck on the short side, I think there is another swivel trade which can bring us possibly to the 20,000 mark in this series itself, and 21,000 by the end of this year. So both from not only from an internal strength perspective, but also from a derivatives positioning perspective, this indicates that this is a second leg of the rally which is beginning, and we are in for a structural upside from here.
Rahul, morning. It looks like the sleeping giant Reliance has woken up over the last few days. What are the charts telling you?
Yeah, so Reliance has been, an underperformer for most part of the time. In fact, the 22, there are twin tops in the 22 calendar year. Post that, we've seen multiple times the ratio. If you do a relative comparison of Reliance divided by Nifty, the ratio chart has reversed from these areas multiple times, 4 to be precise, in the last 18 odd months. So we believe this time also it will not be any different. So a simple catch up to the Nifty 50 would mean Reliance is back to somewhere around 2,800, 2,850. And if that does translate into an outperformance, we could very well be headed north of 3,000 on the upside. So, the risk reward still continues to be favorable for this giant. And we believe there is, more upside to be had in the coming few months. So structurally, we feel 3,000 is very much on the cards by the end of this year. One can look to accumulate around these levels, have a stop loss at 2350, and we feel that this is one of those index components which is yet to fire.
LTIM and Tech Mahindra from the IT space, you like these two, Rahul?
Yeah, so IT index has had negative returns if we simply do a comparison from December till date, from December 22 till date. So only two sectors which fall under this category. One is the metals, which has not performed, and second is the IT, which has been negative. So we feel IT has formed a base. There is a double bottom on the IT index around the 26,100 mark. And now finally, after the base confirmation is done, we feel that there is a good 10 to 12% upside to be had in the IT index in the medium term, and maybe more, towards the end of the year. So clearly, all the IT names like TCS, LTI, Mindtree, Tech Mahindra, for that matter, all of them have structures which are elongated consolidation structures. And breakout from these would mean a quick upside of around 20-25% on the mid-cap IT names and around 10 to 15% on the large-cap IT names. So TCS is something that we like. I think 3,600 odd should be tested anytime soon. On the mid-cap, LTI Mindtree is one which can be a high beta play. We've seen the stock deliver the kind of momentum that traders especially like on the derivative side. So around 20% upside is possible in LTI Mindtree. And as far as Tech Mahindra is concerned, the percentage upside is even more because technically the projected targets for the current setup are coming close to 1,500. So these are more like 3 to 6 month kind of setups where we feel we are in for a structural upside from here. So IT in particular looks good, especially from a risk reward perspective. And lastly, coming to metals. So metals has been sort of an underperformer. Something that we particularly like, JSW Steel setup is quite attractive at this point in time. There are 3 weeks, since last 3 weeks, we've been trying to break out from the 800 mark. I think as and when it happens, then we should be in for a quick 10-20% upside in JSW Steel as well.
Okay, Rahul, thank you very much for joining in. So Rahul saying buy the dips, 20,000 is possible on the Nifty in this series and 21,000 by the end of the year. And he's betting on stocks like Reliance, IT names like TCS, LTI, Mindtree, Tech Mahindra, and even JSW Steel. That's the new debut today, HMA Agro. It's a big retailer of buffalo meat. Exports, 90% of their revenues come in from exports, and the stock has seen a opening in the green, currently up close to about 12%. Issue price was 585, listed at 625, but the subscription on it was not very high, just about 1.6 times, but it's opened up pretty strong considering the market itself is flat. But the other big news today, Harley-Davidson has launched the X440 in India. The bike has been co-developed by Hero exclusively for the Indian market. On the heels of the launch, Parikshit caught up with Harley-Davidson CEO and Pawan Munjal, the chairman of Hero MotoCorp. Listen in to that interview.
Extremely important. At the same time, I have to say I'm also extremely confident about the product, about the success of it, and about the customers that we plan to get on board, and also about the customer delight that we plan to give to our customers. So all that Harley has been doing across the globe for their customers is now only going to get multiplied here through this co-created, co-developed product for Harley-Davidson in India for India.
Right. If I can ask you, how have the two brands collaborated on this product? Has the design come from Harley-Davidson? Has the engine development come from Hero MotoCorp? Give us the backstory.
Well, it's really the companies that collaborated rather than the brands. Hero is Hero, Harley-Davidson is Harley-Davidson, and it's been a true co-creation. When Dr. Munjal and I spoke in 2020 to think about a partnership, we said, well, we should be creating a product together. So it's been a product that has been designed, that's been engineered, that has a look, sound, and feel that is very typical Harley, which was critical to us. As soon as a product carries our brand name, it needs to be a special Harley. But combining that with the expertise from an engineering point of view, from a manufacturing point in India, understanding the Indian customer was very critical. So, it was a close collaboration from the beginning, and I think the product will speak for itself.
Give us a sense of how this partnership has been for Harley-Davidson. You exited the India market but handed over the reins in a way to Hero MotoCorp. X440, how important is it for Harley-Davidson to drive sales in the India market?
Didn't really exit. We transitioned to a new business model, and that was a partnership with a partner that is truly a true expert in the Indian market. That was important for me. We have a global brand, we have global product, we want to be present in India. There was never any doubt in my mind. It was a little bit positioned that way, but it was very clear that we would not leave the market, but come back with a much stronger partnership that could produce a product that we probably couldn't have developed and certainly not manufactured in India on our own. So it's a very important product. It plays in the premium segment. It's part of our long-term strategy to selectively expand into areas that we have not traditionally been in. And doing that by having a partner that has that expertise has been a great experience, and we're very excited and think that this product has a long way to go and a big potential.
Right.
Let me add that that this has been a very, very successful and very smooth transition for Harley products to be sold by Hero through the Harley dealerships that they already established here.
Right. The 440 segment. It seems there's a lot of competition now, Mr. Munjal, in the 400cc segment. You've got Bajaj Auto and Triumph launching two motorcycles in the 400cc segment. You already have the Royal Enfield, which is present here. Why is this segment so exciting?
More the merrier. To start with, somebody earlier asked that why do you want to play in a segment where there are so many people, just like you are wanting to know why the 440 segment. For me, and I'm sure for Jochen as well, no fun in being by yourselves and having a monopoly in these times. When there is competition, when there are a number of players in the same segment, in the same field, we all bring out the best, and best for the customer, which is what we're all wanting to do.
Right. How do you expect this to contribute to Hero MotoCorp sales, Mr. Munjal? Hero MotoCorp has been the leader in the commuter segment for years now. Premiumization is the area which is seeing growth. How do you expect this to contribute to your monthly numbers going forward?
But all I want to say is the Harley-Davidson brand that we are launching here now through the X440 is definitely going to be right on top of our premiumization strategy. And we do have a huge strategy which has already been outlined by our CEO Niranjan Gupta to all of you. We have a number of launches planned in the premium segment starting recently.
Okay, interesting conversation there. We'll keep playing snippets through the day, get into a break. We'll come back and put the spotlight on some stocks which are on the move. Welcome back. Markets flat now, so all the morning gains have been given up, but there are a few stocks on the move. One of them is Genus Power Infra. Surbhi joins in with the latest order win. Surbhi.
Hi Rima, so we don't talk about this stock often. Now it has recently won a 2,200 crore order. This is for installing and commissioning of 27.69 lakh smart prepaid meters. Now management says that the order win provides a strong revenue visibility, and it also signals a strong start to the order inflow for FY24. For FY23 itself, they had an order book of 1696 crores. The financials were not too bad as well. The revenues were up 18%, the EBITDA was up 32%, and they had a margin of nearly 10% versus 9% in the previous year. The stock has actually gained 46% in the last 1 month itself. So a lot of optimism about these smart meters that are coming in.
Thank you very much for that. But the big mover of the day, the stock of the day, is undoubtedly Bajaj Finance. Very strong provisional Q1 numbers reported. Abhishek is here with the details.
Well, it looks like, the biggest NBFC in terms of consumer finance is back with a bang, and how. Look at the new loans. They are up 34% YOY and about 30.8% sequentially. Sequentially, it's perhaps one of the best growth that you are seeing in last 7 quarters. And Q1 versus Q4 is typically not such a high loan growth period, but this time around, it's clocked more than 30% growth over there. The customer base is up 21% YOY and about 5.5% sequentially. The AUM growth on a YY basis at 32.4% is perhaps the best that you are seeing in last 14 quarters, and sequential growth of 9.2% is perhaps the best in last 16 quarters. Average ticket size, that's up only 9.4% YOY and about 3.4% sequentially. Deposit momentum was strong, growing at more than 46% YOY and about 11.8% sequentially. The liquidity in the balance sheet remains high at about 12,700 crore, which is up 7.2% quarter on quarter, and the cross-sell ratio, that's also improved to about 8.3%, which is perhaps the best that you are seeing in last 6 quarters. So a big thumbs up given by Street on the numbers given out by Bajaj Finance. Back to you.
Thank you very much for that. And now the stock is just 2.5% away from its all-time high level. While the stock is trading at a fresh 52-week high, the all-time high level on Bajaj Finance was 8050, hit in October of 2021, and the stock is now inching towards that. CLSA has pegged the target price at 9,000 on Bajaj Finance. With that, it's time for a break. On the other side, our special segment, State of the Economy. Lata will join in, and she'll be joined by Pranjal Bhandari, Chief India Economist, HSBC, and Samiran Chakraborty, Chief India Economist, Citibank, to discuss India's growth outlook.
Welcome to It's the Economy. The raft of data that is flowing for the June quarter is a tad confusing. It's mixed. First, the negatives. Auto sales for June for Maruti, Bajaj, TVS, Hero Motor were all below market expectations. Here are the sales running for you of the biggest car maker and the biggest two-wheeler maker, that's Maruti and Hero. Of course, SUVs or large cars have done much better than compact cars, but as you will see, compact cars down 17% year on year, and Hero Motor, of course, down 10% year on year in terms of sales. Now, coming to other consumer goods data from market research company Bizom, that is only for April-May, they show that consumer goods sales fell 17% in April and 12% in May. Jobs data, the Naukri job index for April-May was down 5% from Jan-March quarter and just marginal 0.5% from year ago. Another index put out by Foundit, which is a subsidiary of Quest Corp, another staffing company, says hiring has fallen 7% in May 2023 compared to year ago, May 2022 levels. Now, let's come to the India services exports, which has been such a winner. That number in May came in at $25 billion, which is down about 8% from the last 12-month average. However, there is two sets of data which is extremely strong. And let me put that also before I go to my guests. India's direct tax collection for April and May was up 12.3% over the year. I mean income tax, okay? I'm not including corporate tax because we will know that only in June when the advance taxes come. But income tax is up 12.3%, which is stronger than nominal GDP. Likewise, GST collections up 12% to 1.61 trillion. Again, at 12%, it's stronger than nominal GDP growth. So, should we worry about growth given the indications we get from consumption, which is already weak, even when we got the Q1 numbers, the Q4 GDP numbers? Or should we worry more about the headwinds that are ahead in the form of, El Nino, the second half of the Kharif, as well, whether we should worry also about some headwinds from global factors because of the likely increase in interest rates. Therefore, an impact on interest rate differential, impact on the currency. I have with me two of the best economists perhaps in India, Samiran Chakrabarti, the Chief India Economist at Citibank, and Pranjul Bhandari, the Chief India Economist at HSBC. Pranjul, Samiran, thank you very much indeed for joining us. Samiran, you are the more optimistic of the two of you because you have a growth rate of 6.2%. Any worries at all because of the data we have just got in terms of jobs and consumption and auto sales? And any worries from what we may get in the form of, lower harvest or global headwinds?
Thanks, Lata. It's a nightmare quarter for economists to project growth because there would be a divergence between the so-called high-frequency data and the actual GDP data for the quarter. If you recall, last year, the high-frequency data was very strong in this period because we were just coming out of the third Omicron wave, whereas the GDP data was particularly weak. In general, there is a decline between the fourth quarter and the first quarter GDP data of around 3.5–4%. But last year, it was close to a 9% decline in GDP between the two quarters. So this year, that base will be favorable, and the GDP growth numbers, in our sense, will definitely be in excess of 8.5% for the quarter, if not closer to 9%, even if you assume significant quarter-over-quarter decline. So the point I'm trying to make here is that while we look at all this mixed data prints, where some of them are showing some sequential decline, we have to understand that part of this is purely seasonal between fourth quarter to first quarter. Part of this is a year-over-year base effect, which is playing out. And in general, we know that consumption has been relatively weaker, and investment/construction is now the primary driver of growth. So my sense is that story is broadly impact. Within consumption, there are two factors I would want to highlight. One is there's a shift from goods towards services, and urban consumption seems to be slightly better than rural consumption. So that's how I will characterize the current situation.
Okay. I'm not done with the growth questions, also because of your latest report on the harvest on inflation. But let me first ask Pranjul what she makes of the first quarter data. Is it disturbing you, Pranjul, even more? You're already sitting at the lower end of forecasts at 5.8%, but you feel confident of that? Does it have an upward or lower bias?
Thank you, Lata. Contrary to all the data that you've given, my sense is that activity has been remarkably strong and robust. You look at the GST collections numbers, they're looking good, particularly domestic GST. You look at corporate margins from the PMI we saw today, or also from the RBI database, which gives us for both small firms and large firms, they've shot up, in the quarter of March. You look at some of the formal sector indicators, even the production of consumer durables has picked up over the last, 2 months. You look at data from the central government and the state government, spending, that is really up. So I would say many things are actually doing pretty well. And I'm going to point it all to one thing, which is oil prices. I think in a way we've completely forgotten that last year oil prices averaged $100 a barrel. And right now we are at $75 a barrel. And this $25 a barrel fall, if it persists, then it itself can give us a boost of GDP of about 50 basis points. So I think that's a big positive, that we have amidst us right now. And I think that's something that's going to show up in the June GDP number that we'll get. Having said that, there are a few things I worry about. For instance, I worry about how rural incomes will unfold over the next couple of months. I don't worry about food inflation, but I worry about rural incomes. And I also worry that, in a way, if you're only dependent on oil, all you need is one great news globally for oil prices to go back up. So these are two vulnerabilities out there.
Okay. Well, just as a matter of detail, Samiran, I would assume that you place much more reliance on something like GST or income tax growth rather than, say, a Naukri index or a BISOM index or auto sales. I guess that is a bigger proof that growth is fine?
I mean, beauty lies in the eyes of the beholder. So it depends on who is looking at the data. If I am a company management, I would probably look at that BISOM data to figure out what it means for my own products. But if I am an economist, then I have no choice. I have to look at the GDP data, which is an aggregate for everything and not just one particular aspect of the economy. So I would prefer the GDP numbers.
Okay. Well, thanks for that. Now, Samiran, what about the growth headwinds? We have seen, relatively, absolutely strong data even from the US with their GDP getting upgraded by 50% from 1.3 going to 2%. The same quarter when even our GDP number came in 1 whole percentage point higher. But the point is that's put all the central banks on notice. Every major central bank is going to raise rates once or twice, and for us, the Fed matters. Can that mean headwinds? We are already seeing that in services exports, I would think.
Exactly. So there are three parts to it. One part is the global part, the second part is the cyclical part, and the third part is about shocks. So you highlighted the global part where there is some amount of global slowdown that everyone is trying to build into their forecasts. We have also lowered our service exports forecast, and that's why talking about a slightly higher current account deficit at 1.6% of GDP now. So to some extent, this will filter into the high-end consumption in India out of some strain from this sector. But the interesting bit is that the cyclical slowdown everywhere, not just India, but globally, the cyclical slowdown is getting deferred and deferred. We are all calling for the peak of the rate hike cycle, but that at the peak of the rate hike cycle, the higher interest rate impact on either consumption or investment is not that much visible. And the last problem is the shocks problem, which are anyway difficult to predict, which is about the weather shocks or any other kind of bad news, so to say, coming out of global commodity price shocks. If those things come in, then that can have an impact. But the primary driver of consumption, which is wages and the excess savings during the pandemic times, it appears to us that at least the wage growth in the urban segment is continuing well, not as much in the rural segment. And unfortunately, on excess savings, we don't have a very real-time data, but that's one headwind that I will be very worried of. To some extent, it will get counterbalanced by the current wealth effect that will get generated out of these asset markets reaching all-time highs every day. But overall, that's the consumption dynamics between the cyclical factors and the noise factors that I'll be very closely watching.
Okay. Pranjal, would you worry that a poor harvest, because El Nino is still a danger for the second half of the monsoon, probably from August onwards, will that, as it is, consumption in the Jan, Feb, March quarter came in at a pathetic 2.8%. Now, if we add to it poor rural incomes because of harvest, can that be a danger to growth?
Yes, Lata, I think one of the things the market is not focusing on is the early arrival of the El Nino. As in, it's come in May, June. Generally, it comes in July, August. And the problem when it comes early in the season is that it only strengthens over the next couple of months into the winter period. And then it can even impact the winter crop by impacting reservoir levels. So I think this is one big risk that we all have to be very watchful of. My sense is that if we do get into a period of weak rains over the next couple of months, I'm not very worried about food inflation. I think that can be managed. We have started off with decent stocks of rice and wheat. At this point, we can import things like pulses and edible oil because prices have fallen. Our government is doing very good supply side management. And, there's a lot of evidence that inflation has come down over the last 10 years because of government action, despite climate change, creating a havoc in unseasonal rains. So all of this, I think, is positive, and we won't really see food inflation really ratchet up. But what will give is rural incomes. My sense is the reason why food inflation is low, which is high imports, is something which will end up hurting rural demand, rural incomes, because our domestic farmers don't benefit when we import all the shortfall crops. And I think we have seen this in the data. Over the last 10 years, real rural wages have been quite soft. Rural terms of trade are more on the negative side. And that is my real worry, growth, not inflation, at least on the rural side. The good news here is that we have fiscal space. We have fiscal space.
Yeah, Pranjal, sorry I'm out of time. I just want one word from Samiran. Samiran, the K-shaped recovery is very obvious. I put it in auto sales, but it's there, even consumption not growing, but investment growing. At some point, the poor consumption can come in the way of growth?
Yeah, I mean, ultimately, a GDP which has 60% consumption cannot keep on growing without consumption picking up. The question is that the distribution between the higher end consumption and the lower end consumption is not very clear to me, that whether it's an 80-20 rule that works there. If the higher end consumption is more of GDP, then at least for a while you can continue this kind of a path. But ultimately there will be political kind of hurdles that we will be reaching in the process. So we need a more balanced growth in some sense.
Yeah, but that is for the longer term. But as you point out, all the Cassandras who have been calling for a lower cyclical growth have been disproved, and cyclical growth at least has not slowed at all. So perhaps even with a late El Nino, we should be able to manage with a 6% plus growth, though Pranjal would disagree about the number. Thank you very much, Pranjal and Samiran, for giving us a little more color on how to understand the various nuances of growth. We wrap up on Bazaar. Chart Past is up.